There's been a fairly clear improvement in the earnings backdrop just over the past couple of months. We look at the chart in front of us, it's global earnings revisions. This is estimates up compared to those down over total estimates. You can see that from quite depressed levels late last year, early this year, that index has moved back up to its around about its longer term average. One of the factors behind that, of course, is the improvement in indicators like the ISM and various PMIs from those early 2016 readings. We can see here, blue line here in this example is the ISM New Orders Index. So you can see how that's pushed up over the last few months. And this is annual growth in trailing earnings for the US. So you might expect just on that indicator that earnings could begin to pick up from here, but also the softening of the US dollar and the increase in oil prices will have also added to the improved earnings picture. If we look at the return composition from, say, US equities over the past 12 months, and indeed going back to, say, 2008, we can see what the drivers of returns have been. Clearly, in the most recent year, returns have basically been flat. Dividends have provided that, offset by a decline or a slight contraction in the PE, with forward earnings estimates basically being stuck at current levels over the past 12 months. We look back to the rally that occurred in markets during the 2012-2015 period. It was a combination really of all three, but particularly driven by PE expansion. But also the underlying EPS growth story of somewhere between 5 and 10% earnings also added. So this is an issue, but is there a sign that the earnings cycle is beginning to turn for US and global equities? So if we look at a chart of the 3-month change in forward earnings numbers, you can see, and the shaded areas here represent the periods where that 3-month change in 12-month forward earnings is above average. So we've entered into a period where that revision is above the average. What has that meant traditionally for equity market returns? So if we have a look at that, use that as one of the rule, and we consider the returns from the S&P 500 in the next 6 months. So we're just pushing this forward to generate a number for the next 6 months. So this is 6-month return from US equities in the next 6 months after periods where, or during periods where 3-month change in 12-month forward earnings have been above average. So you can see that this has occurred 61% of the time. It has been positive returns from US equities over 6 months, 77% of the time. The average is 5.7 versus 1.95 periods where it's below the average. T-stat down here, and you can see the distribution of the returns. So it would seem to have been a positive factor for US equities and could be considered to be a positive signal for the asset class generally. So back to testing some of these earnings indicators in relation to returns from the US equity market. So I've set up US S&P 500 as the series. We're having a look at a couple of different earnings revision type measures. This is the estimates up versus down. This is 3-month change in forward earnings estimates. We break them up into various quintiles, and also have a look at where earnings, 3-month change in earnings is above average. As you can see here, the rule was set up here. So if I'm looking at that one, what it basically shows is that the annualized returns over the next 6 months, let's just rerun that again. The annualized returns over the next 6 months when the 3-month change in forward earnings has been above average has been around about 12.5% versus 5.66% the rest of the time. So it would appear to be a fairly strong indicator of equity market returns going forward. It still seems to work over a 1-year period, 10.9 versus 4.7. So it seems to be a reasonable indicator. Interestingly, if you break it down into quintiles, so if we look at the very strong periods for earnings revisions as measured by this indicator, first quintile, and we run that, we find that the results are not strong at all. In fact, the returns in first quintile versus the other 4 quintiles is essentially the same. So it would appear that returns tend to be best when earnings revisions are in the middle to higher ranges rather than the absolute highs. So it may well be that we're in for a brief period of earnings being positive for markets and supporting US market in particular. But let's have a look at a more of a medium, longer term trend that's in place. So you would expect that earnings over the long term should roughly equate to somewhere around about nominal GDP growth. And in this chart, we're looking at 20-year annualized nominal GDP growth. That's the red line. You can see how that's been tracking down to around about 4%. If we use over the last 10 years, then that number's going to be even lower, but it's as low as we've seen really since the 1930s. If we, excuse me, the two other lines that we see here, reported EPS, that's the blue line, 20-year annualized, and then profits before tax. This is from the national accounts for corporates, 20-year annualized. So a couple of observations to make here. One is that both of these numbers, in broad terms, they tend to follow the GDP cycle or structural changes in nominal GDP growth, but they also are obviously a lot more volatile, but sometimes will diverge. And so we've seen over the past 10 years, they've tended to be towards the upper side of nominal GDP. That might be for two reasons. One, increased profit share, but also perhaps nominal GDP, which should be supplanted or complemented by emerging market or global nominal GDP, which would tend to lift earnings. But I think it's got more to do with increased profit share over the past 10 years, whereas in the 1970s, early 80s, high inflation, increased wages tended to eat into profit share during that period. So if this was the sort of the broad driver, if nominal GDP is the broad driver of earnings growth going forward, you'd expect some downward pressure to continue. At a secondary level, then it comes down to what you think is going to happen to profit share and unit labour costs in particular. So I want to just finish up then with a quick look at profit share and its relation with unit labour costs. So profit share is the purple line, so it has been coming off in the US from very high levels around about 12.5, heading back down. It's still above the longer-term average, which is close to 9.5. The blue line at the bottom is unit labour costs, and that's inverted. So they've been growing at around about 2% over the past couple of years. After having been quite negative, certainly during this 2009-2010 period, which aided the increased profit share. So the shaded areas are the periods of declining profit share, as you can see there in the past, and typically they've been associated with downturns, but also increases in unit labour costs. So remember, this is inverted, so that's an increase in unit labour costs in the late 60s again here, so either higher wages and or lower productivity. Very high unit labour cost growth here. Here, back in the late 1990s, we saw it go from 2 to around about 4%. In the 2006-2007 period, not really a key driver, it was more to do with the global financial crisis. So that's the one of the key indicators we'll be looking at going forward is unit labour costs. And at this stage, wages growing at sort of 2.5%, productivity very weak would suggest that unit labour costs are unlikely to decline. In fact, if anything, to push up slightly higher, which will mean a lower profit share.